Tokenized real-world assets, real estate, U.S. treasuries, private credit, and stocks are being called the biggest opportunity of the decade. Projections show this market could reach $5 trillion to $30 trillion by 2030 to 2035. But here is the uncomfortable truth. Most retail investors will still lose money in RWAs, not because of bad projects, but because of their own psychology and behavior. Hey everyone, welcome back to InvestKonnect, where we connect investing with identity, behavior psychology, and future tech. And in this video, we're going deep into the psychology of tokenized RWAs and how you can avoid the common traps. We'll cover the massive RWA opportunity ahead, the hidden behavioral biases that will destroy most investors, my InvestKonnect RWA psychology framework, and how to profit with discipline and strong digital identity. Let's make sure you're on the right side of this revolution. Tokenized RWAs bring real-world assets on-chain, providing fractional ownership of prime real estate. They enable U.S. treasuries with daily yield and improved access. They open private credit and bonds to a wider pool of investors. They even include fine art and carbon credits becoming tradable on chains. The benefits are huge: 24/7 liquidity, global access, faster settlement, and real yields in a DeFi environment. Institutions like BlackRock, Franklin Templeton, and major banks are already heavily invested. 2027 will be the year RWAs go mainstream. But with every major opportunity comes massive psychological danger. Here are the biggest traps, starting with novelty bias and FOMO, where people jump in because everything is tokenized now. Yield chasing, where investors ignore underlying risk for slightly higher returns. The illiquidity illusion, where people believe tokenized assets are always instantly liquid. Status signaling, where buyers purchase tokenized real estate to show off on-chain. A false sense of safety, where investors assume backed by real assets means zero risk. These biases are amplified when money feels more real than pure crypto. Your identity as an investor plays a huge role in how you behave in RWA markets. If you see yourself as a sophisticated TradFi plus crypto investor, you may drop your guard. Use this InvestKonnect RWA psychology framework before every RWA investment. First pillar: identity alignment. Does this asset match your true risk tolerance and long-term identity? Second pillar: a behavioral consistency check. Are you buying because of research or because everyone else is? Third pillar: psychological risk scoring. Rate opportunities on FOMO-level yield, temptation, and complexity. Fourth pillar: add a digital identity layer using on-chain reputation and verifiable credentials for better access. Fifth pillar: conviction and exit rules. Predefine when you will buy, rebalance, or sell, and then stick to it. Practical tips: start small with a 5 to 10% allocation and dollar-cost average into quality tokenized treasuries and real estate. Combine allocations with a strong digital identity to access reputation-gated opportunities and lower fees. The winners will stay disciplined with psychology and leverage digital identity for better terms. They will focus on high-quality regulated tokenized assets and use AI tools and behavioral systems to remove emotion. Tokenized RWAs represent one of the greatest wealth transfer opportunities of our lifetime. But remember, technology does not fail. Psychology does. Build strong digital identity, master your behavior, and you will not just survive the RWA boom, you will thrive in it. Drop RWA in the comments if you want my free RWA psychology checklist and framework template. And join the InvestKonnect newsletter for deeper research and monthly alpha.